Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And as always, thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with portfolio construction and investing. So starting in 2025, we've had a lot of market volatilities. We have a lot of volatilities in policy making. Essentially, one of our key themes for this year is that you may see an increase in market volatility, even though the overall return proposition continues to be pretty constructive. As a result, we are starting to see a lot more investors in the Asia-Pacific region looking at alternative assets, and I'm delighted to be joined by Anurag Aggarwal, who is our Global Head of Portfolio Management for the Global Transportation Group in Hong Kong today, and he will share with us a few thoughts on transportation, opportunities, and how he thinks that fits in with the portfolio. So Anurag, welcome to Hong Kong.
Thank you very much. Nice to be here, Tai.
So let's start with the basics. Maybe you can introduce yourself and also your team and the investments that you guys do.
Absolutely. So we are a team that sits within the broader platform of JP Morgan's asset management world, where we have the private markets, which is what we call alternatives. And within alternatives, we have real assets. And within real assets, we have four main verticals that we tend to focus on. We have real estate, we have infrastructure, we have transport, and we have timber. Now, interestingly, the way to think about transport, the way we do this, is to think about us as a part of infrastructure. And for all things that people look at real assets for, which is diversified, uncorrelated, income-generating assets, that's exactly what we do. The difference being, within infrastructure, we break that world up into two bookends. There's fixed infrastructure assets, which is your traditional infra assets. And then you have the moving infrastructure assets, which is my world, which is the world of transport assets. So to keep it really simple, use the logic of a 5-year-old. If it moves, it's mine. If it doesn't, it's the fixed infra world. So they as in the infra folks, think of airports, ports, and toll roads as infra assets. The planes, the ships, the rolling stock that actually make up that ecosystem are the transport assets. So our team basically invests in these assets. And in one word, what we do is we are in the leasing business. So we own these assets that we then go on to lease to the large global end users who need transport in their supply chains.
So if we take a step back and how transportation fits in with portfolio construction, you mentioned earlier on the word income and also leasing. So I presume there's an income component to this.
Yes.
But at the same time, if you look at across the spectrum of private markets or alternative assets, they have different characteristics or different advantages. Income is one of them, diversification benefits or alpha generation. What are some of the key characteristics or advantages when it comes to transportation?
So a little bit of everything that you just mentioned. So I'll break it down and say, look, at the end of the day, the main difference that we have to first ascertain is, are you investing for income, which is more core plus style investing, or are you investing for a higher return profile, which in our world we call opportunistic or private equity style investing? The big difference is when you invest in the opportunistic style, your return is driven by the underlying appreciation of the assets. So it's a buy, hold, sell strategy. We do not do that. What we do is, back to the word, leasing. And in leasing, you find income. So where does our income come from? It comes from basically owning and leasing these assets in off-balance sheet financing transactions to large corporations who then will pay us on a daily, monthly basis, which then becomes the underlying ability for us to distribute cash yield-based distribution to our investors. So we do not chase private equity style returns, but we are not faced with private equity like uncertainty in outcomes because leasing has a very predictable income profile. So in terms of what do we bring to a portfolio, we like to use DIYM as a way to remember all the attributes. So D is diversification. Now, diversification in our world comes from the broad mosaic of transport assets and subsectors in which we can invest. So people say shipping, but shipping is one word. within shipping, we have multiple types of assets. So we invest in dry bulk ships, container ships, product tankers, car carriers. You can move over to the energy side and you have gas carriers, LNG, LPG ships. These days with renewables, you've got tons of demand for offshore wind farm related assets. Then you move to aviation, you've got rail, you've got land-based transport, you've got container box leasing. EVs is a whole new world of transport assets. So as you can tell, Tai, there's so many different options I have as a portfolio manager to curate a portfolio that within itself has negative correlation, that gives me diversification, that provides resilience in times of uncertainty.
I think your point about consistent income stream is particularly valuable at this time because, well, the market's not going through huge swings as we speak, but it's always a possibility in 2025. So from that perspective, a consistent income stream, again, coming back to an overall portfolio construction, it does provide a very important bedrock of return. And I think if I've seen a number of charts from your presentations, I think over the years, sure, there could be some mark-to-market changes up and down, but the income component over the years has been very consistent. Would that be fair?
Absolutely. And there's a reason for that, right? Because what are the primary sources of volatility when you think about performance, or where does resilience come from? It comes from the fact that if your underlying assets and your performance is not directly being either affected or being driven by what is happening in the markets every day, that's where you get both the lack of correlation, you get the uncorrelated exposure, but you also get resilient performance. So how does that play out in our world? Leases or leasing is a business where once the asset has been leased, you effectively have a legal contract, which is a take or pay contract that pretty much says, for example, let's say I lease a ship for 10 years to a corporation that has an A-rated corporate credit. Now, for those 10 years, all I care about is, and my lease has a fixed rate and a fixed duration. So all I care about for those 10 years is my counterparty financially solvent and is not going to go into credit default or bankruptcy. Now, I do not care about the underlying state of the markets. I do not care about what is happening with the underlying cargoes, commodities, the price of all things that may affect normal markets. What I care about is, as long as my counterparty is financially solvent. So what is nice about leasing is once you enter into a transaction or a lease, all the risk shifts from the asset side to the credit of the underlying counterparty. And what we have evidenced is by accessing corporate credit through the leasing approach, we've successfully been able to actually outperform corporate bond spreads by about 300 to 500 basis points. Now, the two other benefits of leasing are we own the assets, so we are collateralized by our assets and the assets move, so we like that a lot. And two is, in terms of where we get the priority of our leases getting serviced, GAAP accounting pretty much puts the lease as an operating expense. So I get paid right alongside employee salaries, office rents, arguably before the first dollar of debt service goes towards even the lines of credit. So one of the arguments we make, and this is something which a lot of our investors like, is not only are you getting the diversification, you're getting predictable, resilient performance in terms of cash yield, but more importantly, if you like corporate credit and you can absorb the illiquidity that comes from the private markets, you actually can access that corporate credit and make a pretty handsome premium over the underlying corporate bond spreads. So it is equal parts real assets and credit or private credit in some ways.
That all sounds very good. So I think it sounds like a very attractive assets to own. So who are investing in transportation, both globally, but also maybe more specifically to our audience in APAC, in the Asia Pacific region? Also, are we starting to see more individual investors investing into your world?
Absolutely. I feel like the world of private market investing has evolved and is evolving to the extent where historically these were institutional grade asset classes and or investment platforms. I think what we have observed in the early stages of our own evolution was all the big institutions were there, sovereign wealth funds, corporate pension plans, public pension plans, insurance companies, again, because they like credit. They make up still a majority of the capital that comes into the asset class. But what we are seeing and what we are very excited about is the growing influence of private wealth, of wealth platforms, of the funds channels. And I can tell you this just from our own experience. About 5 years ago, we had, or maybe even 4 years ago, we had less than 5% influence from the wealth and the retail or wholesale side of capital in the world. Today, that number has gone up to about 25%. And it is actually one of the fastest growing sources or wallets for AUM. And that is driven by two things. One, I think we have found ways through efficient structuring to bring institutional grade products down to that level, because it's all about size and minimum size of investment. But I think secondly, and more importantly, the channel itself, I think the investors that sit and live in that world of wealth and wealth platforms are sophisticated. There's a lot of wealth being created in those channels, and they come at portfolio construction with the same approach and lens as the institutions do. They have the same view towards, how they want to diversify away from 60-40, the things that we think about in the institutional world, correlations. Equities and bonds are getting correlated. How do we diversify against that? By bringing in some alternatives. What is the role of alternatives? Can portfolios in that world absorb the liquidity that comes from private markets? All of these things are now equally relevant. So I do think that the democratization of alternatives in particular is a long-term theme that we are all very excited about.
So in the last few years, we've been through a lot. The pandemic, geopolitics, the rise of protectionism. You did mention that when you sign a lease, it's for 10 years. But of course, I presume that the macro factors, the global factors, still impact on your asset class, both maybe in a good way or in a challenging way. So my last question is essentially, when you look at the world today, again, we've been through all these challenges, logistical problems, the change in the geopolitical landscape. What excites you? What worries you?
Yeah, it's a loaded question because there's a lot, and there's a lot that sort of affects transport. So let me try and sort of deconstruct this in a way, Tai, that sort of sets up the entire framework of how we tend to see the world, and then what happens in the world in terms of how does one invest, thinking about both opportunities and risks at the same time. So firstly, I think you have to sort of acknowledge the fact that transport assets, particularly core transport, are critical and essential assets to global trade. This is a fact. 80 to 90% of all goods that are consumed, traded goods in the world, move on a ship. And I often like to say that if it doesn't float, it flies, right? Because if you don't put it on a ship, you're going to put it on an aircraft. But that itself suggests to you that transport is the tail that wags the trade dog, where it doesn't really matter what the impact of, and we've had now 7 years worth of experience where we've been tested. We've been tested by a pandemic. We've been tested by conflicts like Russia, Ukraine, the crisis in the Middle East, where access to the Suez Canal was difficult. We've been tested with rising interest rates, inflation. We are being tested again as we speak, feels like every day, with trade talks and tariff talks coming out of the White House. So we have data now to see how an asset class like this has responded and what is the underlying sources of both resilience and risks that we have observed. So putting it all together, here's a few takeaways that we've had. One, given the fact that these assets are critical to global trade and consumption, what we have noticed is that they tend to be fairly well protected against the near-term immediate nature of what we see coming out of these demand-side shocks. And a big reason for that is the supply side of transport is pretty constrained, and you can't just build ships and planes overnight. So for example, if there's a huge need for new liquid natural gas carriers, which is really what happened when natural gas as a commodity was not going from Russia anymore into Europe because Nord Stream 1 and 2, the two pipelines, were shut down after Russia got sanctioned and the war began. Now, Europe still needs gas. So where's all that gas going to come from? All that demand moved to other producers of natural gas, which is in the Middle East, Qatar, and you had in North America, the Canadians and the Americans who had natural gas to export. But there are no pipelines from these places. So overnight, you see a huge demand for floating pipelines, which are basically liquid natural gas carriers. Now, all of this sounds great if you can just go and order a whole bunch of liquid natural gas carriers, like you would get donuts from Krispy Kreme, right? But the reality is there is about a 3-year backlog to taking delivery of any asset that you were to place an order of today at any shipyard in the world. In fact, the real story of what gets me really excited about the long-term opportunities in transport is less to do with the demand side shocks, because demand tends to be fairly stable when you think about non-discretionary goods. And the fact that 8 billion people or so on the planet have to keep consuming, you're going to need to transport those basic non-discretionary goods and commodities. What gets me really excited is the fact that the supply side of the industry is very, very strong. Strong as in there is no risk of oversupply, and there is growing challenges at the shipyards, labor challenges, technology challenges. The number of shipyards today is less than half of what it was in 2010. China builds more than 50% of the world's ships, and if it's not China, mostly it's Japan and South Korea, where again we're seeing outside of China some challenges around labor and the ability to keep producing efficiently. So what we like to do is we like to look at everything and say that, look, demand shocks can be absorbed much more easily because what you will see is a small variance, and that variance will typically be absorbed by those assets that are not critically embedded in the supply chain of the large end users. So there is a discretionary portion of supply chains that will probably be more impacted, but that is not the core side of the market. That is in our business what we call the spot market, or the market where assets are trading for anywhere from a voyage to 3, 6, no more than 12 months at a time. We take a duration-based approach to investing. Yeah. So we like leases that are anywhere from 5 years to sometimes the entire useful life of the asset, which could be 20, 25 years.
That's a really important point, because we do get asked questions on, if you look at, say, a particular benchmark on freight rates, right, and it does get very volatile, right? Sometimes it can swing significantly over time. But what you do is very much detached from that market. It's more about the long-term lease yield of a particular asset.
That's right. So I think what you referred to is the most commonly used term to express what you just said is the BDI, or the Baltic Dry Index. Everybody loves to obsess about the BDI because the Baltic Dry Index is where they see the most volatility, but it is a proxy of, firstly, the dry bulk market only. And 2, it is a proxy of the short duration side of the market, which actually captures all the cyclicality and all the near-term impact of what we observe in the markets. Now, there is a portion, I'm not going to sort of deny the fact that there is a portion of the world fleet of transport assets that operate in that market, but that is not necessarily the part of the market where you go looking for income. If you're looking for income, you go to the other side of the market, which is the side of the market we live in, which is we're not trying to be thematic and time entry and exit points in the market for return. We're basically solving a different problem. The problem we're solving is transport is critical to supply chains. The end users, which are the large corporations, do not want to own these assets, so they need off-balance sheet financing to have basic access to critical transport. Now, the real point to highlight is it's not a new business. Leasing has been going around for 50, 60, 70 years. The big reason why the private markets have become active in this space is because post the GFC, we saw a huge impact of the regulation that came in the form of Basel and CRD and Dodd-Frank. And what we saw was the incumbent providers of that capital, which were the banks, have been pushed out of the leasing market for the most part. So this is more a story of an opportunity that was created because of the dislocation of the incumbent source of capital in a very well-established sort of framework of the end users that needed that capital and what that capital was being used to effectively fund, which is these assets which are critical to global trade. So it's a completely different use case. And I think it's important to separate the two. Otherwise, you get sort of caught up in that discussion of volatility.
No, I think that's a really, really good point. Thank you so much for explaining all that. So if I may just summarize everything we've discussed today, a couple of things. I think transportation, clearly there are different types, but I think what we discussed today is merely the core part, which I think the key attributes will be the consistent income stream that allows for diversification. Essentially, you're more exposed to the corporate's rating performance, the credit side. And I think that to me is really important in this environment where market volatility could be higher than the last couple of years. At the same time, again, we highlighted this in our 2025 outlook where we do expect industrial policies, trade policies, geopolitical issues to continue to be something that will influence the market. Some maybe in a good way, some maybe in a more challenging way. But the good news is with all the risks that we see, there's always a solution. And to address trade, geopolitics in some way, again, the consistency of income is obviously a solution. But at the same time, we have seen episodes where the geopolitical event may actually raise the lease rates or the fees you can charge, and that in itself is also a hedge against this type of risks. Yeah. So in that sense, again, in order to provide the solutions for investors, not only to satisfy their needs for income, which is, by the way, huge in APAC, but at the same time, in a world where trade policy is being turned upside down, geopolitical event can still flare up, I think transportation is a very much core part of that solution.
Yes, I agree with all of that. And I think just to contextualize risk, because we should also highlight what are the key risks investors should be thinking about when they look at these asset classes. I'd say the first is, of course, you have to understand that private markets come with illiquidity. So while you get the resilient performance and the uncorrelated income, you have to have, in my opinion, no less than a 5-year investment horizon. The longer the investment horizon, the more you will benefit from that diversification and yield. 2 is, these are operating assets. So you are, at the end of the day, you're really focused on manager selection, and you want to work with those managers with whom you can build the confidence that they can be good stewards of not just the capital, but also know how to operate these assets to be able to extract both alpha, but also consistent performance. So I think manager selection and operating risk is something that we should all be mindful of. And then the last thing is, you really want scale. I think the one thing that sometimes gets lost in looking at a comparison across folks that may have similar solutions is what is the benefit of scale? Because in scale, you're able to mitigate concentration risk. And I can tell you this as a lessor, one of the things I think about a lot is I do not want too much concentration of capital, credit, or duration in my portfolio. So the bigger I get, the more opportunities I have to eventually invest across that spectrum of multiple sectors, across multiple years of asset lease renewals, and do business with as broad of a universe of counterparties as is possible. So in our experience, open-ended funds that have the ability to do that have always shown better performance because they have the ability to sustain through multiple cycles in the market as opposed to closed-ended funds. So maybe that's another thing to consider as investors look at these asset classes. But there's a very important role that alternatives and core real asset-based income-generating strategies and asset classes will play, I believe, in client portfolios. And I hope today's discussion has been helpful to that effect.
Very last question. How many ships we own?
So we are one of the world's largest owners of transport assets, particularly in ships. We own today, I think roughly about 170 odd shipping assets. We own companies that have multiple assets within them. We are, I think, in the top 10 ship owners of the world. And we are, in many ways, it's interesting because people don't realize this. When people think of JP Morgan, they think of us as a big financial institution. Yeah. But in our industry, if you were to go to one of the shipping hubs of the world, like a Greece or like in Norway or some of these countries, when you say JP Morgan, they would actually first maybe think of you as a ship owner.
You took my line because I was thinking, you're in Asia this week. If you go to Hong Kong or Singapore or Australia or Taiwan or China, I presume some of the ships that we see in the ports or just even the coastline, it could be ours.
Yeah, absolutely. Could be the ships could be ours. The containers on the container ships, we even own a company that leases those boxes. Look, you might be flying an aircraft that is in our portfolio that we've leased to one of the airlines. We do business with some Asian airlines as well.
We certainly do plenty of that.
Yeah, and I can tell you, look, this is public, so I can share this with you. If you're in the city of Copenhagen and you end up riding a bus in the city of Copenhagen, you will be probably riding one of our portfolio assets because we own now a business that provides public transport and is leading the charge in the electrification of public transport, which is a big long-term theme as well, in this case, in the country of Denmark.
Anurag, thank you so much for joining us. It's very fascinating. I think there's a lot to take away and appreciate this. Appreciate you doing this so clearly.
Yeah, thank you very much.
Thank you very much.
Thanks for having me.
Okay. So thanks for watching. If you like this podcast, please consider subscribing and also recommend this to your friends and colleagues. If you have any questions, also reach out to your JP Morgan Asset Management client advisors and they'll come to us with your questions. So thanks again, and I'll see you next time to discuss what's on Investors' Minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.